Hey guys, I wanted to record a video to address some of the questions, misinformation, angry video posts I've just been seeing rattling around YouTube and Facebook. And I guess my goal in doing this video is to give a pretty unbiased view of how index universal life works, how whole life works. Going to focus mostly on index universal life and I wanted to start by giving you a little bit of my background. But first off, I want to say that if you're watching these videos out there, then I think accountability for comments being made is really important. So let me tell you how you can out me if you think I'm giving you any kind of misinformation or not telling the truth. I'm a general agent with Emeritus Life Insurance Corp. So if I say anything untrue, feel free to go ahead and report me to the compliance department because they will make sure that I stop saying that. I think that should be mandatory for anyone that's going to aggressively share their point of view or their opinion or how life insurance works or how 401ks work. I think there needs to be some kind of accountability. And almost every video I'm watching out there, they share maybe 80% truth, maybe even some of the statements they're saying are true, but they'll leave out little nuggets to where you as the viewer have a really hard time deciphering what is actually real, what's not real. And almost everybody is also using their bias. They're either pro IUL or anti IUL. They're either pro infinite banking or anti infinite banking. So let me tell you, I guess, a little of my bias first, and then I want to jump in and give you kind of an explanation of how the index universal life product works. It's not a godsend solve all for everybody. I think it's a really cool vehicle in some cases. I also am a huge advocate of whole life insurance when used correctly and properly and designed correctly and properly. So this video, sorry if it takes me a little while to get all of this out. I think it's important to be detailed in sharing how this works so you can understand and also work with the right advisor or agent, making sure that you're getting the thing that's actually best for you. So I'll expose how commissions work and those kind of things as well. So to give you a brief background, I'm with Unbridled Wealth. We've been an agency for since 2016, but we were clients of a financial advisor that sold us some pretty significant whole life insurance policies, specifically Ohio National and Emeritus Life Insurance Corp, and SML, Security Mutual Life, some years before that. And we've been actively using those policies in what would be coined the infinite banking concept. So funding whole life policies, taking loans against the cash value, using those to do, for us, it was real estate and small business startups. So very active in doing what most people are teaching about and talking about. So we now have 25 companies under our brand. We've got 9 commercial properties in our portfolio. We do about 100-ish million dollars in revenue across the companies and have been actively using life insurance for infinite banking purposes for about 8 years. So here's one of my confessions. In most of those 8 years, I have been railing on index universal life. I have been repeating a lot of what I've learned over the years from the IBC community, the infinite banking community, and probably propagating some of that misinformation. And so I think part of this is me coming out and saying, hey, I think it's actually important that we tell the whole truth. And even for if you're an agent or a financial advisor watching and you've been very anti IUL as well, then I think this could be a good opportunity for you to uh, listen with fresh ears and look to see if maybe even some of what you have been saying over the years has changed or in fact just was never true in the first place, because I think it's really, really common. So I'm going to jump in and just give a breakdown of how a policy works, some of those basic components. I'm not going to cover everything on this video because that would take me probably a couple of hours at least. So hopefully this gives you enough to maybe address some of the concerns that you've had or some of the things that you're reading. So I'm going to switch camera view here and jump up onto the whiteboard. Alrighty, so there's obviously 3 main components that make up a permanent life insurance contract. So we've got premium, so what you're paying every month or year. Got cash value, and so that's what most of this conversation is about. If you're interested in IBC or using IBC, you'll commonly hear we don't really care about the death benefit, it's the cash value, it's the access to cash, and then death benefit. So to be clear, as I'm going through this, I'm always going to be referring to non-MECs. So designing a policy, which the layman's version of what a non-MEC is that a MEC is the gains in the cash value is taxable if you ever access it. A non-MEC, you can withdraw up to your cost basis and you can take loans for any amount and there'll be no taxation of that loan. But really what I want to address today is two major components: expenses and growth. And I'll touch on commissions as well and how that works. But when we're getting into the argument of whole life or index universal life, these are some of the biggest hot topic buttons, especially when people start saying you can't use IUL for infinite banking or you can use IUL for infinite banking. I want to talk about why either party is saying that and let you decide for yourself what you think would be best. For the record, I actually don't call it infinite banking if you're using an index universal life, mostly because that is a trademarked term by Nelson Nash, and it was his opinion that you could only use whole life insurance with a mutual insurance carrier. So in honor of his legacy and what he's done, I'll call it private banking. If it's index universal life, we'll call it infinite banking if it's whole life. Okay. So premium. Let's just start here in some differences. I would say it's a huge advantage on IUL versus whole life and how premiums work, in that you have massive flexibility. I'm actually going to be specifically talking about the products for Emeritus Life Insurance Corp on this video. It's the products I know the best, and so that's easiest. There's subtle variations and differences with each carrier, with each product. And there's some really, really cool features, especially in the IUL product for Emeritus. So premium. Let's just use the example for easy math. I'm going to use $100,000 because you can see percentages really easily. So let's say you did a $100,000 policy into an IUL. I'm going to use generic numbers. Maybe assume someone probably around 35, 40 years old, good health. Obviously, all of those things impact expenses and that kind of thing. So making assumptions, obviously look for you specifically, you're going to have to run your own illustration. One of the things, actually, let me stick with premium for 1 second. In a whole life policy, each year you have to pay between the base and the total amount of your premium. So let's say you did that $100,000 policy. Typically, you're going to have a base premium, which is going to be somewhere in the 10% to 100% range. And then you have what's called PUAs, paid up additions. Sorry if this is basic for some of you, I'll go pretty quick through it. So PUAs will be the difference. This is partly due to how we do the MEC test, etc. But so let's make some assumptions here. Let's say you're doing 20% base, 80% paid up additions. Something really important to note: commissions. A typical commission on a base premium, so like with Emeritus, an agent is paid 50% of the first year base premium. So if $100,000 policy, $20,000 base, they would make $10,000 on the base. On the PUAs, you would receive 2% commission. That's obviously a 25x multiple. So just be aware of that when you're designing the policy. Some agents are trying to boost up the base, reduce the PUAs. It does give preferred commissions. So just be conscious of that. Okay, so base PUAs 20%, 80%. So in a whole life policy here, you would have to pay between $20,000 and $100,000 each year. There's usually a set number of years, etc. But let's just start there. IULs, it's going to be a lot more flexible, between 0 and 100,000. Does depend on how you design it a little bit. You can also usually do a pretty darn low ratio of, in IUL, it's called excess instead of base. And I'm sorry, it is called target premium instead of base, and it's called excess instead of PUAs. So it's often about 15% to 85% in that ratio. Okay, so that's premium. So let's talk about expenses and how they work with whole life and index universal life. Whole life, honestly, there's a lack of transparency in the whole life world. And again, I'm not taking one side or the other. I'm just going to try and let you know how this works and why people say what they say. Whole life, there's very little transparency in how your insurance costs or premium charges or expense charges work. In index universal life, they actually break it down. You can run a report and see exactly where those charges are coming into effect. So if you did a $100,000 premium in a whole life policy, and at the moment, depending on the carrier, maybe the growth is a guaranteed 3%, and then it's up from there as the carrier earns dividends. Right now, what we're seeing is probably in a 4.5 to 6% range, depending on the carrier. In when you include dividends in the gains on a whole life policy, relatively low. Good potential for that to go up as interest rates do go up in the future. These carriers, talking mutual carriers, are massively affected by interest rates. Last 10 years have been significantly lower than the historical average. Therefore, it's had an impact. Okay, so growth in whole life, really consistent. Most people love the fact that you got a 3% guarantee. Used to be 4, at the moment it's a 3% guarantee, most new products. Plus you got dividends, which have been paid out for 100, 150 years, depending on the carrier. Pretty cool. This is gross earnings. So if you earn 6%, but the expenses were 6%, obviously you wouldn't have any gain. So in that first year, let's say you earned 4.5% and your cash value ended up being 80,000, which would be typical in that whole life scenario. Obviously, your expense in that first year would have been, somewhere around 25%. That would be normal. Sounds super scary. We're looking at a long-term game. If you're watching this, you're probably familiar with infinite banking or looking into it. So you may understand why that can still be worthwhile long-term. So whole life, the pro is the consistency. Every year we've got the floor. You've got a guaranteed column on your illustration, which is going to show you worst case scenario if then there was no dividends paid. That's pretty cool to have. And then also the other thing, the expenses are set at the time of doing the contract. So they can't jack up your expenses 10 years from now, 30 years from now. It is a contract for life with a mutual carrier that's been around a very long time. So that's really, really awesome. I'd say the downside is the cash value. Year one, maybe you've got $80,000, give or take, depending age, health, and how you design it. Maybe by years 5 to 7, you could be break even. And so if you're really looking at this as a long-term play, it can still very much be worth it. I'd say both products have a great opportunity to create arbitrage, which means you can borrow against your cash value at any time. And especially in this low rate environment, you could have a higher earning inside the policy than what you're paying. And so even when using your money, you could still be earning that gap called arbitrage. For whole life, it's going to take a long time to get to that point. Index universal life, it can happen much sooner. But as I'll go into, there's additional risk that you'll be taking on with the IUL policy. Okay, so whole life, safe, boring, long-term, gonna have death benefit, not even addressing that right now. Very steady, a huge plus for IBC folks, infinite banking. Make sure it's whole life policy, well-designed with a mutual insurance carrier. Okay, so let's talk about IUL, because really this is why I'm doing the video, is it's like Republicans and Democrats right now. I don't know what the deal is with the IUL people versus the whole life infinite banking people. Everybody just seems a little bit angry. Like I would say I'm probably product agnostic in that I think they're both great solutions in different scenarios. Neither one is perfect for every person in every situation. So take what you're hearing with a grain of salt and realize that maybe somebody just has a bias that they're propagating. So hopefully I can give you at least some understanding of how IUL works without being angry. Okay, so let's talk about expenses. 3 expenses, usually a premium, maybe worded different based on the carrier. If you're getting an illustration, you can ask the agent for this. Premium expense charges, regular expense charges, and COI, cost of insurance. Those are the 3 main expenses. COI is pretty obvious. You have a cost based on your age, your health, your gender, and you can see that, and obviously the size of your death benefit. So there's a cost per every $1,000 of death benefit based on mortality tables. I'm going to address the comments around annual renewable term that they can jack it up in a minute. First, I'll just explain what they are. Premium and expense charge. This is often a set percentage of your premium as premiums are paid. If you don't pay premiums that year, there would not be a premium expense charge. Then just the regular expense charges. These are often much higher in years 1 through 10 or 1 through 15 or years 1 through 20, depending on the carrier. Again, you can look and see how that works. That's going to be charged whether there's premiums paid in or not, or there's growth in the policy or not. So the reason you could lose money or your cash value go down is if you didn't pay a premium and the growth was 0 for that year, you'd still have expense charges and COI, therefore cash value would reduce that year. So that's why you can hear people saying your cash value can decrease, even if you've got a 0% floor in the index. So these 3 things, if I just call them expenses as a whole, so your expenses on the policy, the difference between the IUL and the whole life is that these can change. So the carrier with an in-force policy could increase your insurance costs, increase administrative charges. Now that's where it's, yes, it's possible. Has it happened? Does it happen? Will it happen? It's like saying, I'm invested in the S&P 500. It's possible that you get a negative return every year for the next 50 years. Absolutely. 100% possible. Has it ever happened? No. Will it ever happen? Very, very unlikely. You tell me if you think that we're going to get a 50-year negative bear run. Probably not going to happen. So yes, IUL, here's the comment I always hear. The insurance company is taking the risk from them and putting it on you, the customer. I'm like, I'm sorry, I just don't really buy that. These are mutual insurance carriers. Yes, they have much greater transparency than whole life, maybe even in some cases have cheaper insurance costs, depending on the year. That can be really, really beneficial for you. Can they increase it? I know with Emeritus, I believe it's true that they have actually never increased the expense charges on an in-force IUL even a single time. And when I spoke with somebody at the carrier, at the home office that's pretty high up, and this is where, send me to compliance if you think I'm lying. They said, if you were to increase as a mutual carrier the cost, the charges inside of the index universal life policy, it would be really, really bad PR. So it may actually have a detrimental effect rather than a positive effect. So if there was a need, if, for example, there was a pandemic or there was a huge opioid crisis like we've got right now, there could be a time where costs are going up. So what they would likely do is increase charges on new policies going into force, not in existing policies. So yes, there is additional risk compared to whole life. Do I think it's a significant risk? Not as much as I think it's a significant risk that my 401k is going to go down in value every year for the rest of my life. Possible, highly unlikely. So hopefully that helps a little bit. So you got your expense charges. So now let's talk about crediting. So again, for an IUL, depending on the product, carrier, etc., you usually have a number of different indexes you can allocate your funds towards. So let's say the S&P 500 as the benchmark index. Most of you know, most carriers are going to have a 0% floor. Some may have a 1 or 2% floor, and then some kind of a cap. Ranging, I'm seeing, kind of probably in that 8 to 10% range here. They usually also have a fixed account, which I'm seeing them ranging in the kind of 2 to 4% range. And then a number of other indexes, usually a Russell 2000 type index. And you've got different strategies within this: 1 year point to point, 2 year point to point, month point to point with different caps. So there's a ton of variations of how you do this. And then there's usually one index that's an uncapped low volatility index. So in this case, there's one by BNP Paribas with Emeritus. It's uncapped. It has a 185% participation rate in the product I'm referring to, and it's uncapped. So all of these still have a 0% floor. In this one, if the index grew by 10% in that 1 year since you purchased or put money towards that index, you'd get an 18.5% credit. It's uncapped. So if it did 20% in that year, you'd get, oh gosh, whatever that is, 37% credit. Obviously, low volatility index, unlikely you'll get a 20% credit, but just giving you an example. So how does this work, and how are carriers able to do this? Okay, so I'm going to address also cap rates and potential for changing cap rates here in a second too. But how is it possible that you could get a greater than 100% participation rate, no caps? How is it possible that they could guarantee a 0% floor, that even if 2008 hit again, 39% drop in the S&P, that you could get a 0% floor? Okay, so they're buying options. So there's obviously expenses within your policy, which is your options costs. And so if they're buying an option, if you understand how options work, they're also buying options on mass scale. So they often get discounted options depending on the index they're buying into. Also means that their expenses change on a bi-monthly basis every time they're buying into those indexes. So because of the options, you can have a 0% floor. And the insurance carrier, again, talking mutuals, their goal is for you to do well. Like the better you do, the better it is for them, because long-term, they're going to get more customers and they can sustain as a business. This isn't some big, greedy, evil empire that's trying to destroy you and like, hey, let's sell them into a 10% cap and then let's reduce it down to 5% so they're screwed. That's not how it works with whole life or index universal life. They're buying options. If the options cost increase, you'll likely see the caps decrease, which you may have noticed the last 2 years. Caps on index universal life indexes has been going down. Why do you think that is? It's two real reasons. Low interest is one. That's probably the obvious one. We know that because mutual carriers are affected by this when they're buying corporate bonds or treasuries or etc., putting it into safe, stable investments. They're earning less than what their entire life portfolio is earning. Therefore, their annual earning as a percentage is creeping down. So we're seeing dividend rates creep down on whole life. We're seeing cap rates creep down on index universal life. Same with both products. So if you're pro whole life and anti IUL because of these, then you're really speaking against yourself, because that is the effect of the current economic state for mutual carriers. So you can't say whole life is awesome and then trash IUL by saying they're reducing their cap rates, because you're kind of speaking poorly against the product you're trying to push as well. The other difference though with IUL versus whole life, the other factor is volatility. So do this as an experiment. If you're an agent at another carrier, go take a look at when there's been decreases in caps in those indexes. I saw a video recently of a gentleman I don't know that was saying how terrible IULs were because he sold a friend a policy 10 years ago with I think it was a 14% cap, and now it's down to 9.5%. Yeah, it's unfortunate that you didn't educate your client 10 years ago, but honestly, that's on you. That's not on the industry. It's not on the product. It's not on the carrier. That's your bad. So using that as evidence for why this is terrible, it really should be a confession of you made a mistake and you improperly educated your client that caps could change. So I kind of wish you had changed the dialogue instead of using that as ammo against IUL. Use it as ammo against yourself, because you're the only one in the wrong there. I'll leave it there. But okay, caps have been going down the last 2 years. One reason is the low interest rates that's sustained. We're starting to see interest rates climb up. That's encouraging for mutual insurance carriers. Means that there's a chance that we'll see dividends starting to come up in whole life policies, which would be awesome for everybody. They still got to get past whatever their portfolio yield is currently. The other thing for IULs, if we're going to see the increase, we need volatility to reduce. Okay, so today is February 25th. We had a pretty significant week in the news and a pretty significant last few months and a pretty significant last 2 years, right? Huge events that disrupted the global economy. March 2020, what happened as the COVID pandemic was publicized fully around the globe. Even later this last year in November, when Omicron, this new variant that rocked South Africa and started spreading globally, was really scary. We saw markets going up and down, volatile. And then most recently, the Russia invasion of the Ukraine. And the news of it the last few weeks, you've seen everything going down. The S&P 500 has been down, the Dow's been down. So most of the time when these events happen, volatility skyrockets. So again, this would be a good one for you. If you're an agent at a carrier, go look at the dates that you saw reduces in cap rates for your IUL and compare it to the VIX index. Now look, it's not going to fool perfectly, and some carriers try and hold out. So let's say volatility goes up. It's March 2020, we still don't know. Some carriers dropped their cap rates in April because they saw this huge increase. The reason being, as volatility increases, option costs, the price to purchase an option, increase. So that means that the carrier is going to start to lose money if they keep the higher cap rate over a long period of time. So they have to adjust accordingly, not because they're trying to make more profit from the individual, not because there's this secret plan of a bunch of evil men in a boardroom that are trying to take higher profits. I can't speak to stock-owned companies or privately owned companies. I'm talking mutual carriers. It's not the case. They're not getting profit distributions as the CEO. Those profits are being returned to policyholders in the form of dividends or crediting on IULs or put into retained earnings for future years. What we are seeing is the effects of volatility. We had 2 devastating years of volatility. So if the next 10 years stay relatively stable and interest rates go up, guess what? We will see an increase in these cap rates. Maybe it'll return to 14, 15%. We should also see increases in dividends if that was the case. In whole life, maybe we'll get back up to 6, 7, 8%. So it's going to be a win-win for all of us. Most of us need to realize we're on the same team. Just because you prefer one product doesn't mean the other one is evil. So that's what we're seeing in cap rates. Can they reduce? Absolutely. Are they reducing because of the company trying to make additional profits? No, they're trying to sustain a business model over hundreds of years, which is the same concept of infinite banking. So that's why we've been seeing these reductions, is volatility and low interest. So if you want to look and see if we're likely going to see more, keep tracking that VIX index, keep tracking the 10-year treasury yield rate, and you'll get a really good idea of what's going to happen. It'll get you the kind of inside info of where the market is going. Okay, so IUL, you're going to invest in index. I think a really cool strategy right now is doing IULs, putting into the fixed rate, especially if you're getting close to this 4% guaranteed growth while this volatility exists. While we're not sure whether the market's going to go down, if there's going to be a correction, a recession, a depression. If that's a fear for you, this could be a really good option, getting that stable rate. Similar fashion that whole life will give you a stable rate as well. So hopefully that makes sense. So let's talk through, actually I didn't mention commissions. So let me talk about commissions in the IUL versus whole life. Whole life, I already told you, is 50% of base and 2% of PUAs, base PUAs. And IUL is actually the exact same, 50 and 2 based on target and excess, okay? There's one difference. If you're doing a index universal life policy with some kind of early cash value rider, remember with whole life, the $100,000 premium, you're going to have about $80,000 in year one in cash value. In the IUL, I'm assuming somebody younger, good health, for both of these, just compare apples to apples, you're probably somewhere in 92 to, technically if the index crushed, if you're one of those uncapped ones, maybe $110,000 range. So the obvious question is, why would you do a whole life if your worst case scenario in this is 92? Especially if you put it in the fixed rate, maybe your worst case or your actual cash value at the end of year one would be 96,000. That's pretty killer in terms of access. There's a couple of nuances why you'd want to do one versus the other. Even looking long-term, size of death benefit, your opinion around risk. But this is pretty cool, having access to this much money. Okay, here comes the criticisms from IBC whole lifers. Yeah, but you don't have any guarantees. Yeah, but we do have a fixed rate. Plus, with this particular policy, if we go to year 10 for these two products, the guaranteed policy or guaranteed cash value on the whole life is probably right around break even. It's probably about $1 million. In that, with this particular product, the Emeritus Growth IUL, it actually has a 4% guarantee for the first 10 years. You get to the end of 10 years, and this may be shocking for some of you. You may, if you're an agent that's been selling whole life, you may not even believe me. Go read the contract. You've got a 10-year look back, which gives you a guaranteed 4%. If the index did 0% every single year for 10 years, end of 10 years, they would credit you back. So your kind of worst case scenario, assuming expenses don't change, which I already addressed that, very unlikely. So worst case scenario, 4%, you're actually going to have more than the guaranteed in the whole life. So if you're saying like whole life is the guaranteed one and IUL's not, please just tell the whole truth. Please just actually share with your clients what the guarantees are inside the IUL as well. And if you weren't familiar with that and you're like, oh, wow, that's crazy, I didn't know, probably a good time to do some research. This is what I have been doing the last year because I've been saying the same things. Comments like this: IULs are guaranteed to go to zero. That is a factually incorrect statement. What they're trying to say is be like kind of punny in that on the guaranteed column of an index universal life policy, it will almost always go to zero, assuming that they don't continue funding the entire time. Because that guaranteed column is showing if expenses in the policy went to the maximum allowed chargeable rate by the carrier day one, and the index does 0% every single year for the rest of your life. Again, do you think the S&P is going to do 0% for the next 40 years? Probably unlikely. Also doesn't account for the fact that we got the 4% 10-year look back. Also assumes that the expense charges goes to the max possible and you keep the policy. Look, 2 years from now, if for whatever reason it happened, there was a nuclear war and they actually had to increase those charges, I guarantee your concern is not your index universal life policy. It's going to be the nuclear war that's happening. Cash that sucker out. As we mentioned, you could have 92 to 100 or to 100% of cash value year one. Take the few percent loss and run. Okay, it's not really a column that you need to focus too much attention on unless you are actually a doomsdayer, in which case don't buy a policy. Okay, the other thing is what I can hear some of you saying, yeah, but you're not talking about the surrender charge. Here's an advantage of whole life. Surrender charges, basically what this means is if you cancel the policy, there's a surrender charge. In whole life, it's zero at all times. So you cancel year one, you'd get your $80,000 cash. There's no charge. In an IUL, this is why it's so important who you work with, which product you're using, which carrier, making sure that they're telling you the whole truth and nothing but the truth. The surrender charge, depending on the product, can be changed. And the reason I'm bringing this up in light of commissions is the IUL product, we can actually reduce our commissions and spread them out over a number of years by using some kind of a rider, usually called something like early cash value rider. So in this example here, maybe the surrender charge would normally be let's call it $40,000 in year one, which means if you wanted to borrow against your 96,000, you actually only had access to 56K. See that 96 minus the 40. So that has been a huge downside for IULs. You know, why would you do this one if you only get access to 56, whereas whole life you get access to 80? Here's why. With the early cash value rider, the agent is agreeing to spread out their commissions, and this surrender charge gets massively reduced. So maybe instead of 40 grand, maybe it's 500 bucks. In which case, way less significant. You get access. This entire amount is still in the index. The surrender charge doesn't stop what's being allocated. It just reduces how much you can borrow against, or if you cancel the policy. So in this one, maybe your day one access to cash, again based on age, health, etc., is going to be about $90,000 in the IUL, whereas in the whole life, maybe it's $75,000. I'm sorry, there's no way around it. I love whole life. I've sold way more whole life than index universal life, but there's no way you can get around those numbers. That's just how the contract's written. That's how the illustrations work. You are going to have access to more cash if designed properly in an IUL than you would in a whole life policy. Don't see any other way around it. Prove me wrong if that's the case. Report me to compliance. Okay, so you're going to have access to more cash. Super important that you're looking at your policy, that you have a small surrender charge, not a massive one. If it is 50% of your premium, talk to your agent, and if they say there's nothing that can be done about it, go find somebody who can do something about it. Why should you not have access to your cash just so your agent can get a full commission in that first year? I just don't think it's right. Again, this video is about kind of exposing how this works so you can make a decision that's right for you. Small caveat, if you look long run, if you keep the surrender charge on, it's actually going to perform slightly better in the long term. But if you want access to cash in the first 10 years, this is going to be the way to do it. So the only time would be if you don't care about access to cash, you just want death benefit, or 30 years from now, then sure, leave the surrender charge on. Okay, I'll give you one final comparison with whole life and index universal life, and that is going to be loaning provisions. So how you take loans. In the IBC world, this is obviously a big deal. I'm also going to share the strategy we use, both personally as a business and for our clients at Unbridled Wealth. Whole life is usually easy. There's often a what's called direct recognition, direct rec, or non-direct. The easy explanation is, say you've got $100,000 in cash value, you want to borrow $60,000, let's say. If it's direct recognition, that's $60,000. It's another one of like hilarious. People often for either direct rec and bash non-direct or vice versa, without actually just explaining what it is. Because sometimes direct rec is better, sometimes non-direct recognition is better. It's ludicrous, but anyway. Direct recognition, $60,000 loan. That would mean that $40,000 continues to get whatever the dividend is paying by the carrier that year, and the $60,000 it receives a modified amount. Sometimes that is the dividend minus something. Sometimes it's a flat rate. You just have to look at your contract or your policy. Non-direct, if you did $60,000 loan, the entire $100,000 still receives the same crediting rate, which can be good, can be bad, depends on the deal. What's usually the case is, and I'll say usually because there's always exceptions to rules, direct recognition is usually fixed. So the new Emeritus Whole Life is a fixed 4%. Non-direct is usually variable. It usually follows some kind of a bond index, like the Moody's bond index. Bonds are low, have been low for a while. Variable interest rates are often low. Actually, at the moment, in the Emeritus, it's 4% still. Okay, 4% fixed, 4% variable. In this case, direct rec means that you would get a reduced dividend on whatever you borrowed. Non-direct, you don't. So obviously you would do the variable non-direct recognition. That's kind of simple for today. IULs, much more complicated. Look, if it's my opinion of who should use whole life versus an IUL, I think the people using IULs are usually those who are more engaged in their investment strategy and their finances. Maybe you're actively looking for investments. Maybe you're a real estate investor. Maybe you're an accredited investor. Maybe you do syndications. If that's you, you fall into that category, or you just really want to be active with your finances, with your investing. I think an IUL could be a great product because you need to pay attention. You need to pay attention every year. If your agent isn't setting up annual reviews with you at the minimum, again, go find another agent. But that is a way more active, hands-on product that you need to stay in the know at. Your agent should be clued into what's happening in the market. So we got 20-ish agents at Unbridled Wealth, and we talk every week about what's going on. Like this next call, we're going to talk probably about what happened in Russia and Ukraine and the effect that it had on the market. I think it's important that you stay in the know as the client if you're doing this, but make sure you're working with an agent that stays in the know as well. And there's a lot more complexities. If you just want a policy that you have access to, if the market crashes 10 years from now, you want some safe money that's stored up that you can take out and go buy a second property because prices drop 30%. Whole life is honestly your way to go, in my opinion. It's safe, it's steady. You don't need to worry about allocations each year. You're not worried about anything changing, cap rates changing. It's way easier to just set it and let it run until you want to access it or need it. So that'd be kind of a distinguishment, in my opinion. The IUL, again, every carrier is different, but for this particular product, depends whether you're in year 1 and 2 or year 3 plus. It has both a direct recognition and a non-direct component. Very similar. In years 1 and 2, you can only use the direct recognition, which is a fixed 3.5%. In years 1 through 5, it credits you 2.5%. So you have this loan, you take out 20 grand, you're going to pay 3.5% on the 20,000. You're going to earn 2.5% on the 20,000. It's a guaranteed loss, negative arbitrage 1%, not that big a deal. Great thing about these loans, if you're using it for business or investment purposes, you can deduct the interest. So your 3.5% may not actually cost you 3.5%. But this is obviously a deficit here in that you're only earning the 2.5%. Years 3 plus, you can switch to the variable, which is currently 3.45%, and keep your money. You could keep it in the fixed account, which is currently earning 3.75. Have that guaranteed positive arbitrage. I've not talked about the expenses. I will, don't worry. 3.45% cost, 3.75% earnings, guaranteed positive arbitrage of 0.3%, or you could leave it in the index. If that year it earns 10%, you'd have a great positive arbitrage. If that year earns 0, you'd have a negative, obviously. This is not accounting for the expenses. So if you earned a 5% positive arbitrage in that year, and your expenses for that year was 1%, you'd actually earn a net 4%. I'm not trying to deceive anyone here. We already went through the expenses earlier in the video, so hopefully that makes sense. So that is typically how you're loaning in each product by the carrier. Here would be, I would say, one of the unique things of how we're strategizing is we have relationships with banks that will do IB locks. Look, we're not the only people that do this. There's other agents that have these relationships. I do have a relationship with one particular bank with our carrier that is doing a deal just for us. And so that is a little bit unique. So I'm not saying you can go down to Wells Fargo and get this kind of deal. Whole life is going to be almost across the board 5% of cash value. IULs, if you leave it in the index, it's typically going to be, most banks, if they do it, will do 75%. We do have a bank that's, if we can illustrate if they're in good enough health, we've designed it correctly, we can show that they're not going to have a huge loss if it went down. If the index did 0% every year for the coming years, they're still actually lending us close to 95%, which is super cool, starting day one. If it's in the fixed account, so currently earning 3.75%, they'll for sure give us, if we design it correctly, somebody's not in too bad health, the 95% of cash value as well. So very, very cool. Gives us a chance to not have to do that negative arbitrage in that first 2 years. We can still access our money and still have some kind of a positive arbitrage in terms of the interest expense, interest crediting rate, meaning that being the positive arbitrage. I think that's all I want to say today. I went way longer than I was planning to, but here would be my request. If you're watching this for the first time and this is brand new information, you have a decision to make. You can decide to ignore it and keep your bias how it is, or you can admit, oh, maybe I actually didn't know the full truth or how this works, and start doing the right thing. That's going to be my big request. If you're watching this and you've been pro IUL and anti whole life and bashing it, my request is realize that we're on the same team in financial services. The people that I think we need to expose and go after are people who are being deceptive, that are trying to just get higher commissions, that have commission breath. That's what I don't like about this industry. It's not whether you do whole life or IUL, or you do assets under management, or you don't believe in the market. At the end of the day, we all have our preferences. But can we stop just being so angry and bashing each other? It will make all of our lives a lot more enjoyable. I know it's more fun to watch when people get in an angry 10-page rant on their YouTube comments, but probably better if we don't do that. And then if you want to learn more, if you're more on the client side and you do want to ask questions, run illustrations, talk to us, then just reach out, www.unbridledwealth.com. I'm sure there's links in the YouTube. But if you've been sent this, then feel free to reach out. Go to the About page. You'll see all of our strategists. You can click on them. They got Calendly links. You can set up a time to meet with them. So hopefully this was informative and helpful. And if you have any questions, let me know. If you're super divisive and angry in the comments, probably just not going to reply. If you have genuine questions, more than happy to talk. Thanks so much.